still tuned into Trading Hour. Let's get you a very special conversation going now. Sunil Tirumalai is Executive Director and India Strategist at UBS. He joins us now to take some questions on the markets and what we could see from here on. Sunil, thanks a lot for joining us as always. This is Pavitra. You know, with the Q3 earnings season done, we have been talking about the slew of downgrades that have come through, especially if you remove the financials performance, it's looked quite weak. I do know that you expect significant earnings moderation from here as well. Can you take us through how much more you expect from the kind of levels that we've seen? And then in turn, what will that mean for the Nifty EPS going forward?
Thank you very much. And, hope all your viewers are safe and healthy. Yes, so if you look at the Q3 earnings and actually look at 2Q and 3Q earnings, because that gives us a good picture of the balance sheet as well. I think there were a few worrying trends that stood out for us. On the balance sheet, it's our working capital for the, let's say, the top 200 non-financial stocks is almost at a 7-8 year high, right? And there are telltale signs that this is not only because of inflation. It almost seems like for the large corporates, their terms and conditions of what was their supply chain has actually generally deteriorated over the last 5 years. And leverage is going up again, not only because of inflation impacting margins, but when I say leverage, I'm talking about net debt to EBITDA, but also because the numerator, right, the net debt is also going up. If you look at the earnings per se, the P&L, etc., I think it's good that inflationary pressures are coming off. And that's kind of helping. I think the margin outlook because of that should be good. But all said and done, we are still seeing very sticky, elevated levels of other costs like SG&A, employee costs, etc. All in all, it almost seems like either from a pre-pandemic level to now, there seems to be anywhere from 100 to 150 basis point upward reset of these costs as a percentage of sales. And which means that even if raw material costs basically normalize, this is something which I'm a bit worried about and struggling with, right? So basically, yeah. So that basically means that from a pre-pandemic position to now, we are talking about the quality of earnings being slightly weaker, right, across all these metrics. So yeah, I think the thing about sell-side consensus estimates is that you normally start higher and start see cuts all through the year. So I would look past that. I think the markets are used to that. Once you adjust for that, my sense is probably are looking at about 6 to 8% lower EPS for the Nifty. As you rightly said, I think a lot of those cuts are actually happening, but it's not visible on the Nifty headline number because of the banks holding it up very well because of the margins expansion. But that could also reverse, right? We are
so Sunil, just to understand the numbers right, when you say that you're expecting 6 to 7% cut on the Nifty EPS estimate, is that X of banks, or are you saying even with the banks helping, the downgrade season has just started? Because I think this quarter at the end of Q3, downgrades are in the range of 1 to 1.5%. Are you saying there's another 5% to go?
So yes, I think you had my banks analyst colleague Vishal last week, and clearly our view is that the banks downgrades could be ahead of us in the sense that the margins expansion that fueled earning surprises from the banks could be coming to an end because now the costs for the banks are now beginning to go up, i.e. the deposit rates are beginning to go up. So at least the support that, so if you look at the Nifty, the 50 stocks in the Nifty, close to 28 stocks have seen earnings cuts in the last 3 months, right? But still the Nifty hasn't seen such a big cut because banks have been holding it up. Now, if the support from banks goes away, you will actually see a lot of those earnings cuts actually close.
Got that. Sunil, hi, Rima here. So one factor which will drive earnings downgrades from here on will be NIM-related compression at the banking stocks, right? That's one factor. What else? What are the other trends that you see which will drive earnings cuts from here on? You spoke about what happened in the last 2 quarters about working capital conditions deteriorating, sticky SG&A. But can you talk about FY24 and what will drive the earnings downgrades?
So yeah, so in addition to banks, globally we are a bit cautious on commodities, right? And when you see earnings cuts or increases in commodities, even though their weight in the index may not be too big, the magnitude of changes can be large enough to actually move the needle on the index. And I think in general, I would say, there is a lot of narrative in the market on rural slowdown and when will the rural recovery happen. I'm not really a big fan of that narrative. I don't know if there is a general widespread rural slowdown. There are companies and sectors which are doing well, even if they have a rural exposure, right? But it almost seems like the market is hoping for a big revival from rural demand. I mean, that might be very sector specific, company specific, and yeah, I mean, in fact, if you're talking about some of the weaknesses that are visible, in demand, then you could see that across a whole bunch of consumer-facing stocks as well.
So what does that imply, Sunil? I mean, you're saying that you're not quite with the market narrative of this rural slowdown. So if there's no slowdown, then don't expect a big revival. Is that what you're saying? That's another than sort of bearish sign for times to come.
That's correct, yes. So, I mean, because the rural slowdown narrative has been built in by 2 or 3 consumer companies. But I don't think that's, if you actually listen to a broader, sample of companies, it's not really, such a widespread problem. I mean, there are consumer-facing companies who are actually doing reasonably okay, even if they're looking at rural. So it seems more like a rich versus poor kind of a problem rather than a rural versus urban kind of a problem. And it just so happens that there may be more, lower income people in rural areas, right? So yeah, I mean, I think I wouldn't bank on a massive rural revival. I mean,
one number answer, Sunil. What is the FY24 EPS growth that you expect?
So I think for so FY24 we are probably at about 9 to 10% earnings growth.
Got it. But I believe consensus is closer to 14-15%. So that's the extent of downgrades we could see. Sunil, great conversation. Thank you very much for joining in. So the earnings downgrade perhaps has just gotten started and it will pick up through the course of FY24. It's a wrap and trading off from the entire team. Thank you for watching.